Hey y'all. Today we're going to talk about interest rates and loans. Building on what we've been talking about, interest, compounding interest, borrowing money, and doing all that, there's something I just want you to consider when you're dealing with interest rates and loans. I hope you don't have to take out a loan one day, but chances are you might. If you want to buy a car, if you want to buy a house, most people have to take out loans. Maybe you won't, and that would be great if you don't. But the rest of the world pretty much lives on debit or debt. So, interest rates and loans. First, you already know how to find interest. We've talked about finding interest on things. It's going to be a percentage rate. We've talked about simple interest and compound interest. Today we're going to compare rates and we're going to compare length. So the rates that you are having to pay back a loan, and then the length that you're going to pay back your loan, and what that effect it has. So like comparing rates and the effect rates have on your loan, and comparing length and the effect of length payments on your loan. And so we're going to be talking about those things today. Just remember, if it talks about monthly payments versus how much you are paying for the year or in total, and then ending balance means your total at the end versus like per month or per year. So those are some of the things we're going to talk about. All right, example 1. All right, Anthony has a balance of $10,000 on his credit card, and the interest rate is 19%. Now you should have, whoops, let me get mine. Sorry. You should have a note-taking guide that has everything typed up. I have something on my screen. Uh-oh. I just didn't write it all out because it would have taken up my whole board. So, part A, to pay off the loan in 3 years, Anthony will have to pay $365.56 per month. So that's to pay off the loan in 3 years. How much will Anthony pay in interest? So if this is how much he pays per month, and we're talking about 3 years, then you would multiply 300, so take your calculator, multiply $365.56 times 3 years, but per month, that would be 36 months. So we need to multiply that by 36, and it looks like he's going to pay back a total of $13,160.16. That's his total he's going to pay back because he's paying this per month for 36 months. But the question says to pay it off, or how much interest is Anthony going to pay? So to find our interest, we need to subtract out the total, the principal that we paid, and it looks like he's going to have $3,160.16 in interest for 3 years. So that's how much interest he's paying above paying that $10,000 back. He has to pay the $10,000. And then over the course of 3 years, he's actually paying an additional $3,000 in interest. Part B, your paper says, so read on your paper, to pay off the loan in 5 years, Anthony will have to pay $259.41 per month. So the payment is smaller because if you're paying over a longer period of time to pay that money back, your payment is actually going to be smaller. So the question is, how much interest is Anthony, going to pay in 5 years? Well, you have to multiply this amount, $259.41, times how many months are in 5 years, so times 12. So that would be 60 months. And this total is $15,564.60. That's the total in 5 years. Subtract out the $10 principal loan amount. So we need to subtract out the $10,000. And his interest for 5 years is $5,564.40. in interest. That's how much his interest payment is for 5 years. Now, option C says, how much more did Anthony pay when the length changed from 3 years to 5 years? So how much more means we're going to subtract. So $5,064.40 minus $3,160, and it looks like our total minus 3160. I hope you're typing it in. $2,404.44. What's the question? How much more did he have to pay? So he had to pay this much more in interest. So he had to pay almost $2,500 more in interest, extending that loan for 2 more years. So that's how credit cards make their money, is they charge ridiculous interest rates, and you pay it back. We Americans, consumers. Okay. Example 2, let's talk about Bree. Bree also has $10,000 on her credit card balance, but she went and talked to a financial advisor who suggested that she go to the bank and take out a loan. If she can go to the bank and take out a loan to pay off this credit card, the bank is going to charge her a 4% interest rate instead of 19% from the credit card. Now, she still is borrowing money, but what she's doing is she's going to the bank and she's taking out money to pay off the credit card, and now she's just going to owe the bank. So the same ABC. A, to pay off the loan in 3 years, Bree needs to pay $295 a month. So $295.41. Oh, no, 3 years. Whoops. I'm getting ahead of myself. I'm doing 5 years. $365. Okay. Sorry, I started reading Anthony. Bree, 3 years, $295.24 for 36 months. That's how much she's going to have to pay back total. And I got, let's just make sure, $295.24 times 36, $10,628.64. That's how much total she's paying back. So when you take out that $10 principal loan, she's paying an interest $628.64. So that's incredibly lower than Anthony, who is paying back $3,000 of interest. Now for part B, Bree is going to change to 5 years. So in 5 years, she is only paying $184.17 for 5 years, which would be 60 months. 184 times 60 months. That is $11,050.20. So her interest is $1,050.20. So now she's up. If she decides to extend her loan to 5 years, she's going to pay about $1,000 of interest. So part C says, how much more did Bree have to pay when the length changed from 3 to 5 years? So again, you're going to subtract the 2, and it looks like it changed about $421.56 more. She's going to pay about $422 more if she extends her loan from 3 years to 5 years. So there you go. Now, example 3. So Bree definitely has a better deal. I think we can all agree that Bree's deal for her credit card is better than Anthony's. So example 3, now let's compare Anthony's interest to B's interest. So we need to look at the last 2 slides. For 3 years, who paid the most and how much more? So first let's write down Anthony paid for 3 years. Anthony paid $3,160.16, and Bree paid for 3 years $628.64. If you're not sure where I'm getting those numbers, I'm just getting them from examples 1 and 2. So we're looking at the interest that Anthony and Bree paid for 3 years. Who paid the most? Well, Anthony paid the most. And how much more? Well, how much more did Anthony pay than Bree? So we again would subtract. So Anthony paid $2,531.50 more. Anthony paid more than Bree. $2,500 more, $2,500 more than Bree, because his interest rate was so high. For 5 years, who paid more and by how much? So let's look at Anthony at 5 years. I'm going back and I'm looking at the slides. Anthony at 5 years was $5,564.40. Bree was $1,050.20. So who paid more? Anthony paid more. By how much? Again, we subtract. So Anthony paid $4,514.20 more in interest. That's just interest. They both had to pay the $10,000 back. But Anthony had to pay $4,500 more in interest over 5 years than Bree did because of his interest rate. So what factor had the greatest impact on reducing the payment? And the biggest factor right now that we're talking about is the interest rate. The interest rate. Definitely, if you shorten a loan from 3 to 5 years, of course you're going to cut out less money than if you extend it 5 years or 10 years. But if you can get a low interest rate, that overall is going to help you pay off the loan or pay off your debt faster than shortening the time span. All right, so we'll practice more in class.